Mike, we talked a lot there about avoiding sort of the panic selling or panic buying even, or anything dealing with emotions. We can't emphasize this enough. Do not be an emotional investor.
Yeah, because if you do, it's going to lead to potentially costly mistakes. And we recommend implementing a very smart plan. There's this psychology of investing, right? Fear and panic selling. We talked about that a little bit earlier. When markets decline, people freak out. They sell their holdings and they go into cash to avoid any further losses. But history shows that those markets tend to recover. And if you do that, you've just locked in your loss because now you're in cash and you missed the best days of the market rebounds.
Yeah. There's also, a little bit of greed as well. No, you're telling me there's greed on Wall Street? No. And then there's also FOMO. Yeah. Fear of missing out that sort of will rear its ugly head for people too.
Greed is good, right? From the movie Wall Street back in the 80s. It is good some of the times. It is not good all the times. And so during bull markets, investors may rush to buy stocks. The problem is they're at inflated prices driven by that excitement instead of logic, right? Buying high often leads to disappointing returns when the market actually corrects. And then there's also this thing called recency bias. Investors tend to overemphasize recent market trends and believe they're just going to continue on indefinitely. And they ignore long-term market history and the long-term market trends. And so all of that can lead to you having less money in your pocket, not more.
Right. And which is just, of course, the exact opposite of what you want to happen. And so what are some common emotional investing mistakes? We've been kind of through the different emotions there and kind of the different ways that people might react. But what are kind of the biggest common mistakes that people make when those emotions take over?
Maybe chasing hot stocks, right? Investing in stocks simply because they're popular or they're hot or Kramer has this tip, buy. They can lead to significant losses when that trend reverses. Things like market timing and trying to predict the market's highs and the market's lows, it's nearly impossible because you have to be right, multiple times on the buy, on the sell. And most of us can get one of those right. Very few, including money managers, get them all right. And then this is a big one that we've seen recently: overreacting to news headlines. So staying informed is important, but reacting emotionally to short-term events can lead to unnecessary changes in a portfolio strategy. My suggestion is don't only listen to one type of news. Listen to the left news, listen to the right news, listen to the British news reporting on what's going on in America. At least you get a much more well-rounded view, and then you can make your own conclusions based on what you're hearing.
I like that advice there, Mike. And one big thing here for folks to remember is diversify. We mentioned that earlier. Diversification so important. That includes a mix of stocks, fixed indexed annuities, and other assets, as you said, because these cycles, they're inevitable, but that balanced strategy can help smooth out the ride. And in just the last minute or so of the show, run through just a couple of strategies here, Mike, to avoid emotional investing.
Yeah, number one, you want to stick to a long-term plan. You got to have a long-term investment strategy that's based on goals, on risk tolerance, on time horizons. That is going to help you weather those market fluctuations. Consider using dollar cost averaging. So no matter what the market's doing, you're buying all the time instead of trying to time the market. Make sure you rebalance your portfolio at a minimum once a year. You should be having annual reviews with your financial professional so that your portfolio itself remains aligned with those long-term objectives rather than being dictated by short-term emotion. And the one I absolutely think is paramount: consider professional advice. Okay. Working with a financial professional can help remove emotional biases from those investment decisions. It can help you keep your long-term strategy on track, and you're focusing on fundamentals, not noise. Okay. And instead of reacting to those market fluctuations, just the value of investments as well as their long-term potential. That's what a financial professional can help do for you.
And hey, I know just the guy. It's Mike Zano. Contact him. moneymatterswithmike.com is the website, and the phone number 704-560-1573.